Yeah, so HSAs are the only account that I'm aware of and that I've ever heard of that actually has a triple tax benefit. But an HSA, you put the money in, it's a deduction, it grows tax-free, and then if you take it out for medical expenses, it is taken out tax-free.
I mean, if you bought a $3 million home at the same rate, now you get a $900,000 write-off.
That's right. That's right. There's two strategies really left that you can do this late in the year if you file an extension actually until the extension deadline. And the only two things left.
What's up, Wealth Builders? Today, I have got a tax strategist. You know, taxes are something we all have to pay, and yet we want to figure out how we can not pay them and how we can limit them and get them far down as possible. And so we're going to go over a bunch of different strategies for anybody to pay less in taxes and put more money in their pockets. I've got Greg Taylor. What's up, man?
Hey, how's it going?
It's good to see you. For those who don't know, Greg, how long have you been in the program?
About 3.5 years.
So 3.5 years ago, you joined because you were thinking about starting to invest in real estate.
Yeah.
You know, and then as a byproduct, your tax firm has kind of grown from everything we've been doing together and stuff. And so it's awesome to see, man.
Yeah. Thanks. Yeah, it's been really great. So really enjoyed the journey and learned a ton.
Yeah. So let's jump into it. At the time of this filming, you know, it's pretty much tax season right now, and a lot of people are trying to file and do different things. And I mean, at this point, it's too late to like really have a strategy, right? I mean, kind of what's done is done.
Right. There's two strategies really left that you can do this late in the year if you file an extension actually until the extension deadline. And the only two things left is maxing out the retirement accounts, those contributions if you haven't done that, or contributing to an HSA. So.
And what's an HSA for those who don't know?
Health savings account. So it's just money that you set aside specifically for medical expenses.
And is that like a tax write-off from your current income this year?
Yeah, so HSAs are the only account that I'm aware of and that I've ever heard of that actually has a triple tax benefit. So most accounts, retirement accounts, you know, maybe when you put the money in, it's tax-free or it grows tax-free, but then when you take it out, you pay taxes on it or some other combination of those three things. But an HSA, you put the money in, it's a deduction, it grows tax-free, and then if you take it out for medical expenses, it is taken out tax-free. So,
wow,
yeah,
I've never heard of that.
It's the only one that has the triple tax benefit.
Yeah, so to be clear for those listening, pre-tax would be, hey, we're going to take the write-off now this year. So if I put some money towards a retirement account, let's say, and I put $100,000 in, that means I get a tax write-off of $100,000 this year. But when I take the money out of retirement, when I'm old, I will pay tax on whatever I take out, correct?
Yeah, well, depending on the account. Yeah, either you put it in pre-tax or you put it in post and then you take it out.
Well, as I'm saying, so post-tax would be, hey, you know what? I'm going to actually pay tax on this $100K this year, and now it's going to grow tax-free. So when I take it out, there's no taxes.
Correct. Yep.
Yeah. So that's an important thing for a lot of people to know because, like, if you're looking for a tax write-off this year, you need pre-tax.
Right.
Because anything post-tax is you're paying tax on it anyways.
Yeah, that's right. There are some savers credits and things like that for smaller contributions into different types of retirement accounts as well. But it only really helps if your income, I believe, is below the $70,000 mark if you're married filing jointly. So it's a pretty low bar in order to get that savers credit.
Yeah. So let's just talk about entrepreneurs and real estate investors, since that's most of the people that listen here, and just in general, right, with tax strategy. So, you know, somebody was coming to you guys. What's the first thing you guys are doing?
So the first thing we're going to do is look at their structures, because people come to us and they saw on TikTok that you should have a trust or a Wyoming LLC, and all those things can have different benefits. We're going to talk through structure. One of the big things with structure is people will own property in an S-Corp, and we always want to get that taken away. You don't want to own property in the S-Corp. And then beyond that, then we're going to start looking at what properties they have, how much depreciation they've done. I actually had a guy come to me this year, and he had actually fully depreciated a piece of real estate in year one when he came to me. And I was like, hey, we got to fix this, you know? So we're going to look through those things and figure out what the situation is and then go from there with a game plan to make sure that they're doing things the right way.
Okay. So let's talk about depreciation, because this is one of the big things that you see online. Obviously, I've used it a bunch. And when people hear depreciation, they might think about like cars and other stuff, but let's talk about depreciation as a whole, as if no one's ever heard of it. So like, what is depreciation?
Sure. So depreciation is basically taking the expense of the asset that you purchase. So an asset being an item, a car, a house, a piece of construction equipment, on and on the list could go. And taking that expense, and instead of taking that whole expense in 1 year, you're dividing it up over a number of years, depending on what type of year frame the depreciation schedule allows for. Some people would say, well, why don't I just take it all up front? You can't always do that because the IRS has set guidelines for certain things, and we have to depreciate them over different periods of time.
But just like, even like I even have a hard time explaining this when I'm teaching it for real estate investors, but it's like, okay, but why do you even get depreciation?
Yeah.
Like what's the point?
So the IRS is acknowledging that things wear down over time, right? So like the easiest example for all of us to see would be a new car, right? We hear all the time, Dave Ramsey says, you drive it off the lot and it, goes down in value. And so the second you drive it off the lot. So things go down in value over time, typically. Real estate is some weird hybrid because it doesn't actually go down typically. It typically goes up in value, right? But the IRS allows you to depreciate that asset, to claim that expense over a period of time.
Yeah. Yeah, it's interesting because real estate does go up, but like the building does deteriorate.
Yes.
It's interesting because it should maybe be called like deterioration.
Yeah.
Because that's really why they're allowing you to take a write-off. They're saying,
Correct.
hey, this thing, this car, this plane, this house, it's going to deteriorate over time, and we know you're going to have to put in work to fix it and everything else. I mean, I don't know if that's the example of how they use it for a car, but like that's how I think of it for a house.
Sure. So with a car, ideally, one of the things that people would say, especially in business, if it's like a work truck for a construction company or something, let's say, they're going to depreciate that vehicle. It's going to go down in value over time. And then when they take it out of service, they quit using it for their business, then it's going to be worth zero.
Yeah.
And so at that point, they have fully depreciated it and fully used it up. So, and those things don't always happen over the same period of time.
Right. So let's just say, like, what is the depreciation schedule for like a car, a plane versus real estate?
Sure. So cars are typically 5-year. Real estate, if it's commercial, is 39 years. If it's residential, which means somebody's living in it, less than 4 units, it's going to be 27 and a half years.
I know. I always wonder, like, where did the half come from?
I don't know either. You would think it would match maybe with the loan term, which is typically 30 years, but the IRS doesn't always do things that we understand why. So
yeah. So meaning, okay, the best way to explain this is, so a car is 5 years. If I buy a $100,000 Tesla Model X, I can basically take $20,000 a year with normal depreciation.
Yes, if it's used 100% for business. Yeah, so there is a category for if it's used a percentage of time for personal and a percentage of time for business, you then have to apply that percentage as well.
Got it. And then what about, the accelerated depreciation?
Yeah, so Section 179 is currently fading away. We're hoping it's passed one side of Congress. We're hoping passes the other side and that the president signs it back into law to make it permanent or at least extend it. Section 179 basically says that certain vehicles over 6,000 pounds, you can depreciate a significant portion of those upfront as bonus depreciation. And so currently for 2025, that's at 40%.
So it's at 40%. It used to be 100.
Correct. So if you had a $100,000 vehicle, like you said, bought it for $100,000, used it 100% of the time for business, you would take the full $100,000 that year.
Yeah. And Trump is trying to bring it back to 100,000.
Correct.
Or 100%.
Correct.
Got it. And then with real estate, you're at 27.5% or 27.5 years. And you essentially take the building value and divide that by 27.5.
That's right. That's right. So that's standard depreciation. Again, we have bonus options there. We have cost segregation. So there are options to get more of that up front.
Yeah. The way I always explain it to people is like, yeah, I mean, normal depreciation's not really anything in real estate. Just to do the quick math, if I had a building or a house that's worth $275, that's the building value of the home. You divide that by 27.5, that's $10,000 a year of depreciation. I mean, I guess it's not terrible, but like a cost seg, a cost segregation study, cost seg for short, gives you the ability to do bonus depreciation. And how much of like that can you really get?
Yeah, so typically it could be anywhere from 20 to 40% that you're able to accelerate and take on the front end. One thing to keep in mind, and I've had clients make this mistake or people who have come to me without talking to me about it first, they'll buy this $3 million, $5 million beach house, right? That's right on the beach.
Yeah.
And land doesn't depreciate.
Yeah.
So the beach house might be worth 1.5, and they think they're going to get 40% of the 5 million.
Yeah. The land is the expensive thing.
Right. So the land is the expensive thing in that case, or a lake house, or something like that. So
Got it. So for that example, you're looking at, if there was 200, let's just say $300,000 for an easy number, 20 to 40%, let's call it 30%. 30% of 300,000 is $90K.
Mm-hmm.
So you start to kind of see how this starts to stack. I mean, if you bought a $3 million home at the same rate, now you get a $900,000 write-off.
That's right. Yeah, and if you have a W-2, then you're stuck on some of those things unless you move into some type of short-term rental loophole or something like that. So with a regular W-2, if you just have a passive long-term rental, you're going to be capped by passive activity loss limitations. And if your W-2 is too high, you may even be capped because of that as well.
But you're talking about a loophole to become basically a real estate professional.
So you're not all the way to real estate professional status if you do the short-term rental loophole. You're qualifying, I guess, technically as a real estate professional to apply that short-term rental to your taxes the same way as you would if you're a real estate professional. But you're able to still keep your W-2. It's very hard to qualify as a real estate professional if you have a W-2 as, say, an engineer or some other type of job like that.
But what a lot of W-2 people do is have their spouse become the real estate pro.
Mm-hmm. That's right. That does work for people who want to go that route. It is a little bit more hoops to jump through. It also can be a little harder to prove if you don't have a significant portfolio or you don't have a license or some other type of position in real estate.
Right. So basically to be a real estate pro, you have to have what?
750 hours per year spent, and more than 50% of your income needs to be from real estate activities. Those are the two basics. There's some other ways that are more difficult that you can qualify with as well.
Okay, so 750% or 750 hours, or is it and or?
It's and with that one.
And over 50% of your income comes from real estate activities.
Correct.
Okay, and real estate activities could be a lot of things. Like, what are some examples?
Yeah, so building, developing, lending is a tricky one because it's not specifically listed on the IRS site, which I think is a mistake to not have mortgage lending listed as a real estate activity.
Yeah.
But it wasn't listed last time I looked anyway. Obviously, buying and selling, wholesaling can qualify, flipping can qualify, things like that.
Yeah, and then obviously managing, property management. What about construction?
Yeah, so developing or any type of construction, qualifies as well.
What about educating?
Yeah, so that is a tricky one. It's not abundantly clear. So I think you would have that's kind of a gray area. And so if I were talking to a client who was in the education space and not in the development or any of the other ones, I would probably give them some information. And then we would make an educated decision together with them understanding the risk of that potentially being challenged if they were only educators.
Yeah. No, I get it. Yeah, I mean, I obviously do both. I was just curious.
Right,
it's an interesting thought. Like, what about like a YouTuber who talks about real estate?
Yeah, if that's the only thing they talk about and they only do, webinars on real estate. I mean, maybe, I guess, because you're training, right? We would probably not call it education. We'd probably call it training.
Yeah.
Real estate trainer is what you would be. And so I think if we used a profession like that and could prove that was the majority of your time, then I think that would potentially work.
Yeah. No, it's just an interesting thing. Mm-hmm. So, you can be a real estate pro. What is the short-term rental loophole?
So short-term rental loophole, I really like for people who have W-2s, any type of W-2 job, because it allows you to, if you spend 100 hours or more, so instead of that 750, we're down to 100 hours, which is a lot less. It's roughly 2 hours a week at a real estate activity for your short-term rental. And you can group them together if you have multiple. So if you're responding to, messages on Airbnb, if you're renting it out, VRBO, something like that. And then you have to be spending more time than any other one person. And so that can kind of mess with people because they're like, well, I have a property manager. They do all the stuff. I just respond occasionally. But if they have a property management company and they have a different maintenance guy, a different cleaning person, a different, person who shows the property, a different photographer, if all those things are different, you could potentially still be above their their management group.
Yeah, because the management is not
it's not one person.
Right. That makes sense.
So you have to be the highest, you have to spend the most hours of any one person and then also have at least 100 hours.
Right. So, just even thinking about that, I actually, I keep hearing the short-term rental rule, but because I've been kind of like hating on short-term rentals recently, because look, I've been in Airbnb since 2017, and been doing this way longer than most people have been teaching it or thinking about it and everything else. And I've sold off most of them, but I still have a few. And it's like, yeah, when you think about everything that the market is doing, I'm just like, yeah, I mean, I get it as a great way to, basically do depreciation. But if you're looking at it from that lens and that's the way you become a real estate pro, then I would actually then like it. Mm-hmm. But if you're looking at it from like this thing of cash flow and everything else, I'm like not a fan for its future.
Sure.
Because it's just getting harder and harder and, more regulations and saturation and all that.
Yeah, absolutely. So one thing that I have some clients that will ask about it with the short-term rental is, well, I need the cash flow. And a lot of times my question to them, and I'll pose it to you, is would $200 more or less per month change your life in any meaningful way?
No, I don't of course for anyone, right? Really. Yeah.
Yeah. So it's not going to make a difference. So if you lose $200 to $300 a month off of this rental property, but you're able to save 20 to 50 to 100,000 in taxes, and you're able to have this appreciating asset, if you don't need the cash flow, that's a really great example of how to protect yourself from taxes and invest in something that's going to go up in value.
Right. Right.
So,
yeah, that makes perfect sense. So, obviously, real estate is a great way via depreciation to lower your tax bill. What are other ways that people can do?
Yeah, to lower your tax bill. So some other ways you mentioned, obviously the depreciation related to vehicles is a good one. You can pay your kids. That is another one. If you have kids, that can be a really creative solution that can really help you to save on taxes and provide for your kids' future, either through retirement contributions for them because they now have earned income if you're paying them for jobs that they're doing, or it can be something that you can do to help them just to learn and grow and also pay for their own expenses. So for example, if your kiddo is maybe a teenager and would be getting a part-time job anyway, and you're having them start pay for their own gas or their own cell phone, or save up for a car or whatever. So you're paying them for the job that they're doing. That's a deduction from your business, potentially with no tax liability to your kid if you do it the right way. And then you're able to help them save and learn how to manage money, things like that.
So how much can you pay them?
Expenses. So up to the standard deduction.
And that's 12?
So, no, it is actually right around 15 this year.
15. So. Okay, got it. So basically, your first $15K you make, if you're anyone, is tax-free.
Right. The standard deduction. Now, if you're paid through a W-2, you're still going to pay Social Security taxes on it, but income tax is tax-free.
Could you pay them as a 1099?
Yep. So that's what you do. So with your kids, because of family-owned business rules and things like that, you can pay them. You don't always have to even issue a W-2 or 1099 if you do.
Can I pay my one-year-old?
So in that case, we're looking more. The answer is yes, but you got to set it up.
He's a baby model.
Yeah, exactly. Image and likeness is what you go with there. So
okay,
you need to make sure that they're actually being shown on some of your material for marketing or other types of things like that.
Yeah. Judah's everywhere. Everyone loves Judah. He's the cutest baby ever. So, what about? I mean, look, does doing things like that put you up as a potential flag for audit?
So potentially it could, if you're doing an S-Corp. Well, if you're doing an S-Corp, you wouldn't pay them that way. So if it depends on how you're paying them and what type of things are going to be auditable. So if you're just paying them and they're actually doing an expense, it's not really going to be a specific thing that's going to come through because you just have contract labor as an expense. It doesn't say, hey, I paid my one-year-old. It says I paid contract labor. And so it's not really identifying that it was your kids on that. So, and as long as you have records and proof that you did the thing, an audit isn't scary if you actually have proof and you didn't tell lies. So
yeah.
Okay,
got it. So you can pay your kids. What else can you do?
Yeah, so we talked about retirement HSA contributions. That goes for anyone. That can be a really great one. One that a lot of people don't.
Hold on. Are you a fan of retirement accounts? Because I know this is a dicey subject for entrepreneurs.
Sure.
And I'll start off by saying I have a retirement account. I started it in 2017. I have not contributed to it in a long time because I no longer care. But I'm just curious your thoughts.
So I'm a fan of retirement accounts. I am not a fan of the stock market. So when I talk about a retirement account, and what I encourage most of my clients to do is to consider those investments that they know a lot about, whether that's crypto, precious metals, private lending, real estate, their own business, things like that. So you can move that retirement account to self-directed. You can transfer that money over. You can also, if you have a 401k, you can borrow against it up to $50,000 at a time. And then you can then use that money for real estate or any other type of investment that you would want to use it for.
Okay. And is there any specific retirement accounts that you recommend? Because there's so many of them.
Yeah, so I stick with self-directed when I can, and I encourage my clients to do that. I encourage you, if you have enough income that you need to shelter from taxes, that you would then max out all of them. So your IRA, your 401k, like all the ones that you can, so that you can then protect that income. Again, we're not talking here about the person who needs money every month. We're talking about the person who has their living expenses, they're comfortable with their finances, and then this is excess, right? And so that excess can then be put in these different vehicles that save you taxes, and we're not worried about, oh, but I got to get some money back off of that every month, or I need that money to live off of.
Right. Okay, got it. So retirement accounts are another way. What's another thing?
Yeah, so we talked about paying your kids, retirement accounts, travel, obviously, like I traveled here. So that is deductible. Your meals are deductible while you're traveling. I had a client actually ask me, this was interesting, I had to look it up. They said, well, I don't go out, I get groceries because I'm on a specific diet. And you can actually have your groceries be deducted as well if you're traveling out of state for things like that. So specific diets, if you can get a medical note from a doctor or a dietitian, can actually be medical expenses as well. So that can run you down a whole nother path there.
Right. Okay, got it. So, obviously there's lots of things, and I want to talk about tax strategy here later on, but I'm just curious, and I honestly, I know a lot of your background, but I don't even know the full picture of it because, dude, you've had a crazy life.
Yeah.
To get to this point.
Yeah.
How'd you even become a tax strategist?
Yeah, so things started out pretty differently for me. I went to college actually to get a degree in communication studies and was planning eventually to go to seminary to probably be a missionary. And after college, I decided to move to Louisville, Kentucky to be part of a church that was starting up there. And while I was there and working and helping with this church start, the pastor asked me to start doing the books for the church. And so I started doing the books for the church and was then decided to work on an MBA at University of Louisville. And while there, I got other job offers to work on books for other companies, other small businesses. And so kind of around 2011, this bookkeeping company was born while I was finishing up school and kind of deciding on life and what direction I was going and those kind of things. And so after a lot of prayer, I kind of felt the Lord leading me to move more towards making a lot of money to send people, to be giving and be generous with my finances. And so we moved away from actually going and more towards sending. We still do short-term trips. My wife and I took the kids to Cuba last year for a week on a short-term mission trip as a family. And so we love that kind of stuff. But long-term and our primary focus is to be able to send more people. And so then from 2011 to 2016, so about 5 years, I was growing the business. Things were going fairly well. We had bought into a CrossFit gym. We had bought into a daycare that we owned a pretty big percentage of. And then I woke up one morning paralyzed from the armpits down. Like nothing in my body worked. I couldn't move my legs. Nothing worked.
You woke up and you're like...
Yeah, so over the course of a weekend, I got sick. And then by that Monday morning, I couldn't move. So,
whoa.
Yeah. It was pretty scary. So throughout that time, we went to lots of doctors, obviously, figure out what was wrong, all those kind of things. So
they're just wheelchairing you around like, hey, we don't know. He just woke up this way.
Yeah, that's right. Yeah. So they didn't know, what the problem was stemming from. And so I went to the Mayo Clinic. I went to University of Texas Southwestern.
How long were you basically in this way before somebody had a solution?
Yeah, so I was in a wheelchair for about a month or so, and then a walker maybe for about 3 to 4 months. Honestly,
so
a lot of that time
to get
is
some
foggy.
strength back?
I did. And one of the reasons they let me leave the hospital, so like I said, we used to own a CrossFit. I used to work out there every day. And I could carry myself basically on the walker and kind of drag my legs along. And so they let me leave the hospital because I could move on my own at least somewhat. And so left the hospital, was mostly in a wheelchair at that point, going to church, all that stuff. My wife was taking care of me, and then moved to the walker and then the cane. Eventually started driving again, kind of all the things I had to relearn. So
yeah. But what happened? What did they say?
So it's a pretty rare disorder. It's called transverse myelitis. And basically my immune system attacked the nerves in my spine, and my spine swelled up, and signals just weren't going through from my brain down to my feet. So.
And then what did they say is like the solution?
So solution is basically time. Only about 10% of people get to the point that I'm at again who get this. So
Whoa.
Yeah, very, very few people actually walk again. So I'm very
There's
grateful
no like treatment.
No, because it's just damage to your nerves. So like there's a cord here on this microphone. If it got a nick in it and started arcing, the electric arc on the microphone cord, that's what my nerves were doing. And so my brain then says, oh, this signal doesn't make sense. It's not right. So I'm going to interpret it as pain. And so it can't send a full signal. My brain thinks it's pain. So I had phantom pain from the knees down for years, and still do occasionally.
Whoa.
So, yeah.
So, I mean, what was it like spiritually going through that?
Yeah. So it was really hard. My
spiritually,
wife,
your family.
Yeah.
Everything.
Yeah. So, we have an amazing church family. I lost all my clients. Like, we were on food stamps, we were on Medicaid.
Whoa.
Like, we had nothing. We had a $600 house payment at the time and had no idea how we were making it every month. And it was amazing. We'd come home from our gospel community group with church, and there'd be $600 in cash laying on our bed. Still don't know who did it. Multiple months
Whoa.
in a row. God just provided through friends and through our family and through so many people. So
wow,
real blessing.
That's incredible.
Yeah.
So obviously, you're praying and just praying for a miracle, and it just slowly starts to come back.
Yeah. So over time, I had I think it was 2 spinal surgeries and like 3 or 4 back surgeries. So got a really bad infection from one of the surgeries. Was actually in the hospital for a month with my back just wide open. They had
Whoa.
you could see my spine. My wife has literally
for a month
seen my spine. So it was wide open. I was in the hospital for a month, but it was wide open for like 7 days, 8 days, something like that. So,
that's insane.
So yeah, I have a picture of my spine.
I don't want to see it.
Yeah, that's okay.
So, dang.
Yeah.
When did things get better?
So it's been slow progression. So actually, one of the things that's really cool, and this is just a testament to the right coaching, which I encourage everybody to get in coaching now. From the 5 years, 11 to 16 that I had my business, I was doing it all on my own. No coach, no employees, no nothing, right? And I grew from $0 to $10,000 a month.
With the daycare, the CrossFit.
With the daycare, the CrossFit, yeah. And just kind of, and even that I think was a mistake, because I was splitting my time, splitting my focus, right?
Yep.
I wasn't all in on one thing, getting it to a point of success. And so then after that happened, we lost everything. The daycare was kind of our only thing left that was still running. We fortuitously sold the CrossFit gym right before COVID happened, and so we made out pretty well on that deal. But so when we started back up in 2020, 2021, I got in the All-Star program pretty quick and learned a lot about how to actually grow a business the right way. I wouldn't say I'm a professional, but I've certainly learned a ton. So that's just been a testament. And since the All-Star program, we've like almost 30x'd so in our revenue. So
that's crazy.
Yeah. So it's just been amazing.
So you guys joined at a time where, when did you start the tax business?
So the tax started right before I got sick, and so then I took a couple years off, and then with the sickness, and then redid a lot of training and learning. And at first, I was only doing personal returns, so I didn't move to business returns until probably 2020.
Okay, so you've been doing personal. What made you even get into the tax space?
Well, I was meeting with my tax preparer to do my taxes and to talk about that. And I was always bringing him strategies. I was always telling him, hey, can I do this? Hey, can I do this? And then I'm paying him all this money, right? And so I'm paying him for me to tell him how to do a better job on my taxes, and it just didn't seem to make sense. So
So as an entrepreneur, you're like, I'll start a business and do it myself.
Yeah, sure, right? That's what we do.
That's every entrepreneur's response to any kind of
problem.
Yeah.
Just
so
start it up.
You start it up. Obviously, the sickness happens. It kind of goes on pause, and then during COVID, you start the business again. So at that point, was it just only tax?
No, so I've always done the bookkeeping and then
tax and bookkeeping, just the accounting.
Yes, just the accounting. Yep, that was the only. Well, I've always had real estate. So I bought my first property when I was in college. And rented the rooms out to my friends, and that was kind of my first adventure into it. Everybody in my family, except for one uncle and aunt, have owned rental property or their own businesses. So it's kind of just something that
you guys always
it didn't feel super scary like it does for a lot of people. It was just kind of like, this is a risk. You're going to have a month that you have to pay for this mortgage and you don't have rent coming in. It's just part of the game.
So, I mean, you had mentioned, right? I mean, the tax business has grown 30x since you joined our program, and obviously we don't teach tax.
Right.
What made you initially join? Like, this was 3.5 years ago.
Yeah, so I was actually going to ramp down the accounting business, the tax business, and go all in on real estate. And honestly, a big reason why was because of this sickness, right? And so if I got to the point where I couldn't work again and my clients were going to leave because I couldn't do that, I needed either a business that could support my clients without me being in it.
Yeah.
If I were to get sick again, or I needed another source of income that didn't rely on me physically being present. And so my effort then was to go more into real estate to build that business so that it could be eventually, and I know this is a long time coming, but eventually be more passive.
Right.
It's never completely passive, but more passive. So
you joined because you want to start doing real estate at a higher level. Was your plan to flip or wholesale, or was it just to get more long-term rentals? What were you initially thinking?
Yeah, flipping and burring, and then eventually, getting into just long-term rentals. So
okay, and then at what point? Because I don't even know the story, but at like what point? I didn't know you were thinking about shutting it down and just going all in on that. Like, what switched?
So what switched was I started talking to people here at the program, and they were like, oh, I don't know what to do about this, and I'd be like, well, you can try this strategy, for taxes, or you can. So I think I joined right at May, and then I came to the first All-Star. And so a lot of people were talking about, oh, my tax bill, all those things right at that time. And so
good problem when people in the program are making money.
Right. And so then as that happened, I was just able to talk with people, and they were like, hey, can you help me? Hey, can you help me? And so that was kind of my first big step of growth. And then I kind of realized, I remember at the first WealthCon that I went to, I wrote down, I have to hire people.
Which WealthCon was this?
It was the one at Mandalay Bay. Layla Hermosi was speaking.
The Hermosis were there. That was in October of 22.
I thought it was 21, but maybe it was 22.
That one was 22. Yeah.
Okay.
So you go to that, obviously, like now you're talking to people and stuff. I mean, I just kind of look at it. It's funny, right? I mean, obviously, you learned a ton of principles that have helped a business grow, but just getting in the right room got you more business too.
That's right. Definitely. Getting in the right room is amazing. I remember, and I think I've shared this with you before, but just feeling offended at that statement, like you got to pay to be in a room, like that's offensive. Why don't people want to just be friends with me, or whatever. And so, but it's just so true. Like getting in the right room, it validates you and it validates the people in the room, right?
Yeah.
Especially if there's a cost to be in that room, whether it's a time cost, a travel expense, or an actual membership of some kind.
Yeah. What's crazy is, I did just now our mastermind. I was telling you guys, the mastermind's literally going on while we're doing this. Right. And I was like, guys, it's crazy for me. I just was reflecting on all of this, and this is the 5th year. Like, we've done 5 straight years of this every quarter without stopping. We've never missed a quarter. And I was like, wow, like it's crazy that, we've had that kind of consistency and longevity, but also too, that people still want to come.
Yeah.
Because there's people who have been coming since, July of 22.
Yeah.
There's people who have been coming since, I was talking to Kristen. She's been coming since 2020. I'm like, it's crazy that it's like there's enough value to keep, because everyone comes from everywhere. Like, I had everyone show their hands. I'm like, how many are out of state? It was everyone.
Right. Just about. Yep.
So that's something that I don't take lightly, and I'm really proud of. But part of it too, you said about paying to be in a room. It's interesting because I said, man, like if you want to get around high level people, you're going to pay in some way.
Right.
And like I'm fortunate in that I have people who come to me to be on this podcast. I was sharing with you guys, I had Dean Graziosi here, and we just filmed his episode, and it was awesome. And for those who don't know Dean, he's partners with Tony Robbins, and he's done over $1 billion in sales and just education.
Yeah.
And this guy's been around a long time, obviously well off, smart, doesn't need to come here. And I was like, yeah, like, so what else are you doing while you're out here? He's like, oh, I just flew in for this, and then I'm flying back. And I'm like, that's crazy that people are coming. Like, I'm nowhere near this guy's level of business acumen and what he's accomplished. But, okay, why is he coming here, right? It's because I've paid. I didn't pay him to come here.
Right.
I've paid in other ways, though. I've paid in that I filmed hundreds of episodes. I spent lots of money on my staff and production and all these things. I've spent many, many hours getting good at doing a podcast and making it a place where people want to come and where it's worthwhile for them to come. People hear about their business. They get good exposure for what they're doing, and they're introduced to a new audience and, all this stuff. And I'm like, oh, I've paid a lot of money for him to come here.
You sure have.
Right? And so
time.
Yeah, money, time, everything. And people just don't really understand that, where it's like, well, dude, I'm not going to go pay to be in this thing. Like, I should be invited to that thing. And I'm like, well, if no one's inviting you, you're not clearly as valuable as you think.
That's right.
And people just need to get a reality check of, it's like, bro, if no one's inviting you to their thing, you ain't valuable in the way you think you are.
Right.
You're overvaluing yourself. And, pay to be in a room. Or have enough influence and exposure where people want to come to you.
Right.
Or where everyone's inviting you. They're like, please come to our room. Please speak. Please be a part of it. If that's not happening, then people don't know you.
That's right. Yeah. Yeah, I think it's really interesting how much that can feel to the person who maybe hasn't gotten that wake-up call or hasn't like really thought through how to grow their business or even how to grow personally. I mean, nobody's offended by paying for private school or paying for college or by paying for those things, right? People pay for them all the time. But the idea of paying to learn at a conference or be in a room where you can rub shoulders with someone who's going to give you that little piece of information, just like what you shared at the last mastermind you went to when you were speaking a little bit ago, like being in that room gave you valuable information.
Yeah, like even that mastermind I went to. I haven't been to like a mastermind in a while because I get to mastermind every week when people come in here and I'm just like learning so much. But I went to this mastermind in Austin and it changed my entire perspective about my business and how I was going to grow it and everything else. And this mastermind, you couldn't actually even pay to go. It was free.
Okay.
And it's like, oh, well, it's like no one paid to go. The guy who was holding it was just like, hey, I only want to take high-level people and just get them all together. I will cover the cost. I will put it on, and I will curate the room and everything else. No, there's no pitch. No one has to do anything. Just show up. And I was like, I respect that. Let's go.
Yeah.
But the only reason I was willing to go was because he said, here's the other people that are going. And I said, okay, like clearly this is going to be worthwhile for me to go. So it's like he basically got together a bunch of high-level people and said, hey, this is worth your time to come, right? Usually people pay you to come and speak at things, but I'm not going to pay you to come. You come on your own dime if you want, because it's going to be worth it.
Yeah.
And it's like, yeah, there's so many ways, but everything is value-driven. You don't get the invite if you don't have the pedigree.
Yeah, if you can't provide value,
yeah,
then you're either the only thing left to provide is dollars, right?
Yeah.
So you're either providing value to the people in the room or you're providing the dollars. So.
Well, it's still just providing value. Like value
That's
is
true.
derived
You're
from.
Right. You're right.
I'm going to give you money, or I'm going to give you attention and exposure, or I'm going to give you knowledge that you're seeking, and like it's all the same.
That's right.
So if you can't provide somebody a platform or attention, if you can't provide them knowledge that, they don't currently have, or you can't just pay them, then you can't really give any value in the business world.
Yeah, that's right.
So, I mean, speaking of that, right? I mean, obviously, you've grown a lot. You've done one-on-one with me. It's been great working with your business the last year and growing it. What would you say is the biggest thing that's been the biggest like light bulb moment for you in your business in this last year?
So two come to mind right off the bat. One is how important marketing is. Again, back to that, I just struggle to pay for people to like me, I guess, or to be included. You know, that's a thing. But in my head or whatever. But,
people should just buy from me.
Yeah, they should just look me up. Without any effort on my part and just want to buy from me.
Yeah.
So, that's not how it works in the real world. But so marketing, the importance of that, and the importance of actually having a plan instead of just throwing some dollars on a Facebook post to boost it, but actually having a plan for your dollars and then the KPIs to measure that, I think is huge. And then the other one I think is figuring out what is the most important constraint or fire or whatever, and working on that one first and not getting distracted by all those other ones. So
yeah, I would also add things I've noticed just working with you personally.
Yeah.
One is and I'm going to say things that I know other people deal with. A lot of times we don't have proper perspective on what's actually happening.
Yeah.
Because I remember, one time you're like, dude,
more than once I've done this.
Yeah, you're like, dude, it's crazy. We're like losing clients now and it's not good. Like, I'm not sure if what's going on. We're going to have to fix this process. I go, well, first off, let's talk about it. How many people did you lose?
One.
And you're like, one. I was like, what are you talking about? And he's like, well, I'm like, you have hundreds of clients and you lost one. That's nothing.
Yeah. Yeah. It felt significant. It was somebody I was close to. So, that made it feel, I think, more significant than it was. So it was very good to be in reality.
Yeah, and like even with employees that happens, with customers, right? You're like, dude, I can't believe this person left me for this other company or whatever, right? Like you like overreact one way or the other. You're like, screw them.
Yeah.
Like they don't know what's going on, or oh my gosh, like I can't, like the world's ending. This person left. I don't know how, like, what are we doing wrong? And it's like, dude, people just leave.
Yeah.
Like people leave for a lot of reasons. And a lot of times it has nothing to do with you.
That's right.
Like their business changed, their life changed, they're just not in this thing anymore.
That's right. Yeah.
Like it is what it is.
Yeah, it definitely happens. And it's been, I would say maybe even that's been a theme even before I knew you kind of personally. That has been a theme of our relationship, right? Like even from that first mastermind that I came to, like, and hearing, you got to pay to be in the right room. Like you've been really good at telling me reality in a lot of ways in my life. And so I really appreciate that.
Yeah. I kind of like think like a robot because people are very emotional, right? So in any situation, I literally just am like, okay, so like, let's look at the facts. Here's the facts. What do we think about this? Objectively.
Yeah.
It's like, okay, let's not read into the narrative or the emotions or whatever else. And that's what's helped me through a lot of different storms. It's funny. Like we were talking about this even on the All-Star call. Like I go over everything that's a problem in my life, my business, everything else. I go, I had this lawsuit, and I've had many lawsuits in my life. So first off, any lawsuit, I'm just like, okay, whatever.
Yeah.
Like it is what it is. But I had all these people calling me like, bro, are you okay? Like, what's going on? Like, are you scared? And I was like, no. Like, this isn't my first rodeo. Like, I've done this many, many times. Like, 99% of lawsuits don't ever go to court. They always get settled or stopped. Like, that's just the objective statistics of a lawsuit. And it's like, so what am I going to do? Am I going to go, like, worry about something for years while it's playing out, knowing that it's very unlikely to actually do anything?
Right. Yeah, and I've heard even from some larger business owners that they just have a kind of legal settlement fund that they just put a little money into every month because they know something's coming.
Happen.
Yeah. So
yeah, you do enough business and volume and things, like just crap happens, and it is what it is. And so, like, even for me, objectively, if I was to get into the emotional side of things, screw these people. This person did this. I did this thing for this person, and blah blah blah. It's like, no, dude. You know what? Like, that's life. That's business. People are going to be upset. People are going to leave. You're not going to have employees forever.
Yeah.
Like, it is what it is.
Yeah.
You can't get mad about it. You just, can't get caught up in all the emotions that come with this.
Right.
And it's hard because, for me as a leader, I have to have like the strongest foundation for my company. So if like I'm looking strong and, very calm and just able to like really problem solve and not let my emotions get the best of me, that transfers into the organization. So
Yeah.
if everyone's like, yeah, dude, like Ryan ain't worried about it and I ain't worried about it, I'm not. but if I am, guess what? Like, dang, is my job going to be in jeopardy? Is this the place to be? So it's like the number one most emotional people would be salespeople.
Okay.
They're easily the most emotional people. So emotional. You have to constantly like know what button to push with salespeople. You got to know when to hype them up. You got to know when to show them praise. You got to know when to be hard on them. You got to know when to console them.
Mm-hmm.
Like, sales is a very emotionally driven thing because most people buy emotionally.
Yeah.
So if somebody doesn't, make a sale, there's a lot of emotions vested in making the sale.
Yeah.
Whereas I look at it from the top and I'm just like, okay, so what are the numbers? I don't know every story that happened to that point.
Yeah. Yeah. And as you grow, right, you can't know every story. It's just impossible to know about
you can't.
Every customer, every client, every sale
But truthfully,
call.
as the leader, I don't want to know every story.
Right.
I mean, this is the truth. For example, if I looked at every comment on every video I've ever done, I would make videos.
Yeah.
Like if I looked at every single person that didn't like what we do, I could have 100 people who love what we do. But you know what? If I see 2 people that
2 comments,
write a bad review or whatever, right? Like you really look at the 2 comments. You're like, dude, freaking this person. But there's 100 people who loved it.
Yeah.
And so like back to objectivity, it's like, objectively, like most people who write reviews objectively, at least with these kinds of things, are like usually going to be the upset people. People who love, like, unless you're really pushing people to do reviews, which every business should. We don't do a good job of it, but you should. The reality is it's like less than 1% of people who actually buy from us are truly not happy.
Yeah.
Like those are the stats.
Yeah.
Like you can look at the thousands and thousands of people have sold, look at any negative thing, it's less than 1%.
Yeah.
Yet we like place so much value on those.
Yeah, that makes sense. I think too with my business too, as it grew, right, there was a time when I was in every client's books and every client's tax return and every client's kind of life on at least a quarterly basis. And that's just not the case anymore. So as like for a while we talked about lifetime value of a customer, right? And for a while that was an unknown for me because I didn't have people leaving at all. And so then as time's gone on, it has changed because there's more people, there's more, employees involved, and I'm not always the one directly involved. So I can maybe take that a little more personally because I should have been more involved.
Right.
So,
yeah. So, I mean, they're just important lessons as a business owner, especially as you scale. And I would say even like as you scale, obviously that gets harder, but it's also hard when you're small.
Yeah.
Because you only have 10 clients.
Yeah,
and so
the impact of one client leaving. Yeah.
Yeah, like then it starts to really hurt and sting. So it's like a double-edged sword. Either way, it's hard.
Yeah.
Because that was what I was telling you actually.
Yeah.
Remember you were like, hey, what happens if this many people leave? I'm like, well, how many employees do you have now? That's still the same percentage that left.
Yeah.
Versus when you were small.
Right.
It's just more. You just have more people, but the percentage is the same.
Yeah, and we've been trying some of what you said about hiring more than you need because people aren't going to stick around or they might not even make it through the
onboarding.
Full onboarding or whatever. So, yeah.
Yeah. I mean, I was talking about that with just out there just now. I'm trying to hire this massive sales team for Home Run Offer to do more nationwide deals. And it's like, I know 3 out of 4 aren't going to work. Like it's going to take me getting rid of 3 out of 4 to find the one killer in the bunch. I don't get mad that 3 out of 4 didn't work. It's just like, it's just what it takes.
Yeah. And setting that expectation on the front end is really helpful, because a lot of times you go into hiring or anything like that and you're like, all right, I'm going to hire this person. They're going to be great.
Yeah.
I did my interview process. I found the one,
Yeah, this is the one. I'm really excited about this guy.
But if you said, hey, I'm going to interview and do this, and I expect 75% of the time this is going to flop.
Yeah.
So,
well, if you remember that one WealthCon you went to, the first one with Layla, she actually did a thing on hiring. I don't know if you remember.
yeah. No, that's why I wrote that in my. I have to hire. Yep.
Yeah, but she talked about it in a great way, and I've said this before too, where it's like the way you have to think about hiring is the same way you think about marketing in general, right? So if I'm trying to market to get new customers, I know that, I'm going to generate 100 leads. Dude, they're not all buying.
Right.
Out of the 100 leads, if I can get whatever your, conversion rate needs to be, if I can get, 5% of them to buy with me,
Yeah.
that means 95 of them did not.
Right.
And I'm going to do great with 5%.
Yeah.
And it's the same thing with hiring. Like, I got to market to get the top tier talent. And guess what? I'm going to get all these applications. I'm going to do all these interviews. And you know what? I'm actually going to go into contract
Yeah.
with, let's just say, 5 of them. And I know that not every single one of them are going to work out.
Right.
And
Yeah.
that's okay. But we set expectations with them too of like, hey, you know what? Like, we need to see something from you in the first week. If we don't see like natural ability in the first week and work ethic and things that you can control and we know you have, we'll just tell you to go, because there's no point to waste your time or our time. We don't want to keep investing into training you.
Yeah.
And then, if you can make it past 30 days, then you'll get a true job offer. That's kind of how we're doing it with sales. Now, other positions are different, right? Like, I can't hire 3 bookkeepers and, be like, all right, you do these books, you do these books, you do these books, who wins, right? Like,
Yeah.
sales is a little bit different. But still, if you want the great bookkeeper, you better go and get 20 candidates
Yeah. That's right.
to figure out who's going to be the one.
Yeah. And the expectation needs to be that I expect 19 of these to not stick around. So,
Yeah.
and I think sometimes it is easy.
I'm going to have higher standards.
Yeah.
Because I could, when I say I'm going to keep 1 out of 4, I could keep 2 out of 4 or 3 out of 4.
Sure.
But I want killers. And other people will self-select out too. It's not just me getting rid of them. They're going to be in it for a week and be like, bro, this ain't for me. This is like, these standards are too high.
Yeah. Well, yeah. Or they see those standards and then
I ain't cut out
maybe
for
they,
this.
on the front end, they see them and they're like, no. Or maybe they go through their first week and realize how hard it is to hit those standards. And so then they self-select.
Yeah, for sure. So going back to the tax world, right? We talked about different deductions you can do. But like from a strategy perspective, I mean, you're getting people, obviously you're going through, their initial setup. Hey, like, are you structurally set up correctly with the, your LLCs and stuff like that? Hey, like, here's some simple things we can do with your kids, all that. Like, what is actual tax strategy after that? Like, what is the continuation?
Yeah, so we are looking at their books regularly with them. So quarterly is a good time frame to do that.
Yep.
And so once a quarter, you can look at your books. You can say, here's your taxes from the last quarter that you would owe if this were the end of the year. We can make projections. So we look at a pro forma a lot of times that projects all the way through the year. And then we address the strategies that they're doing. So one of the big questions I get from real estate clients is, how many properties should I buy and cost seg if I want to get?
Exactly.
So I had a client this year that we got to November of last year. She had about $500,000 in profit.
Yep.
And she got on the November call and she said, are we done? And I said, yeah, we're done. We got, because of cost segs, because of depreciation, that $500,000 was gone.
Yeah.
So she had zero taxable income because she had done that. And so I hear a lot from people, how many properties do I need to buy, or how much should they be? Those kind of questions. So we'll project out that number throughout the year, and then we tweak little adjustments. But the big things are kind of those big buckets, like we're maxing out the retirement, we're doing the cost segregation, we're doing a vehicle if they want, we're paying their kids. All of those things kind of start at the beginning of the year. And then each quarter, we're kind of looking to see that we're still on track. and then we're making any adjustments or adding any additional strategies that we have not already implemented.
What would you say most people are doing when they're buying these rentals for depreciation? Are a lot of them doing short term? Are they doing long term? Like, what are they doing?
So it's a good mix, honestly. So like I said, I really like the short term for the people that are W-2s. If you're a real estate professional, I really like the long term better. And then they're just doing the cost segregation studies. So
got it.
The benefit of short term is that you get the furnishings and all those types of things, right? Because they're typically furnished.
You can write all that out.
Right. So that is automatically got a bonus depreciation. But the benefit,
and just to give clarity for those wondering, that means that if you spend $50K on furniture to furnish it, you can just write that off year one.
That you can use bonus depreciation. So depending on what the percentage is for the year, yeah.
Right.
So,
got it.
But it's the year placed in service. It's not the year that you started. So, for example, if you've had a property for 3 years, but you've never done a cost segregation study on it, we apply the rules from, we're in 25, so we apply the rules from 22.
But you get the deduction in 25.
Right.
Got it.
Yeah, there's just a form you fill out.
Yeah, that's a question everyone always asks. Hey, I already own rentals. I've never done this. Can I do it now?
Yeah, absolutely. Yeah. So you typically don't, they say you can go back up to 15 years, but you've kind of already done a lot of depreciation over 15 years.
Because you are naturally taking it anyways.
Exactly, yeah. So I normally say 5-ish is a good number. You don't really probably want to go back more than 5 years.
Yeah, because you've already taken out so much.
Exactly, yeah. So then you're paying for this engineering study for the cost segregation, so you don't want to go back too far.
Okay, so you're helping them project out for depreciation, other thing. Is there anything else that people really need to know about?
For the real estate specifically, you would want to make sure that you just have all of those, expenses related to property management, that you have your property taxes, your lawn care, utilities, all of those types of things, that you're tracking those. What will happen a lot of times with, especially when people are starting out, is they'll have, my insurance actually is part of my personal insurance and it's on auto bill and I don't have that separate for this property, or my lawn care guy just goes over and cuts that, but he bills me for my personal, all those things. So having those records is really important, and we help a lot of people get that stuff in order at the beginning as well.
Yeah, so like if somebody was to hire you guys, what can you do for them?
Yeah. So if we can handle books, so we can make sure that their things are categorized correctly. If they're doing flips regularly, we're going to make sure that we're tracking those income and the expenses really per flip, so that they can know what the profit is on each flip. A lot of flippers love Excel spreadsheets or Google Docs spreadsheets. And we frankly like those too, because what we do is then use that as a double check, because often what happens with these flippers is they thought that this expense was on this property, but it was actually on that one.
Yep.
And so that double check of their spreadsheet against our books can really help us make sure we have the right number for those profit on the flips. So, and then we prepare the taxes, obviously, and then do the quarterly strategy.
Got it. What can just non-real estate people do? Other entrepreneurs.
Yeah, so a lot of those same types of expenses can exist. So if you have a business, let's say an insurance company, for example, and you have an office space, you could buy that office space. You also have the furniture, like these things we're using right now. All of those expenses are deductible, sometimes depreciable at bonus, sometimes just deductible outright as expenses. You still have the same things with retirement maxing out, paying your kids. So a lot of those same things can still come into play no matter what type of business you have.
Got it. Okay. One thing that people always ask about is the S-Corp.
Mm-hmm.
What's the significance of it?
Yeah, so what happens with if you have a single member LLC, which is just you own the LLC, you're in business, and you're the only owner, and you're not electing a different taxing status with the IRS. So S-Corp is actually just electing a different tax status with the IRS. You're saying, IRS, treat me like this instead of like this. And so when you set up as an S-Corp, you're able to then split your profit into two different categories. One is kind of your earned income for the work you do on the business, and the other is your profit for owning the business. And so by doing that, you eliminate some of your Social Security taxes. So if you have a business that you own by yourself, and it's not an S-Corp, all of your profit up to the Social Security max is taxable for Social Security. If you have that business and you split it into the S-Corp, then the S-Corp allows you to say this portion is salary, this still gets taxed as Social Security and this portion is not. And so that can really help you to save on those Social Security taxes. You can also then implement payroll, have some withholding. You can treat yourself like an employee in some other key ways that allow you to have additional deductions.
Got it. And then I've been talking to different people, and it's something I've been thinking about, especially as we build Wealthy Investor to be bigger and potentially even like more corporate. What is the advantage of doing a C-Corp?
Yeah, so C-Corps can be really advantageous if you're giving minded, I'll say, because you can deduct the contributions out of your business. So right now, like if we have S-Corps for our businesses and partnerships and other things, but in all of those situations, those contributions just flow through to your personal. And so then they're deducted on your standard, against your standard deduction or itemization, depending on which way you go. So they don't actually decrease your profit in your business. So a C-Corp, you can then deduct up to 30% of your profits as donations if you actually make the donation. And so that can allow you then to have that as a write-off on your business. And currently C-Corps are taxed at lower interest or lower tax rate than the highest tax rate for individuals. And so you would then be taxed on that money at a lower rate. The downfall is if you pull that money out of a C-Corp, there's only two ways you can really do it. And that's either dividends or distributions and a W-2.
Yeah, and if you do dividends or distributions, you're going to pay the normal personal income tax rate.
Capital gains, and things like that.
So how what would be the advantage for a guy like me to do it?
Yeah, so one thing that you could do is you could set up a C-Corp, and then basically that could be like a consulting corp. You would bill for your services, and then all of your giving would be able to be out of there. And then the also, employee benefits and things like that. So those retirement contributions, all those types of things that build your wealth. So again, we're thinking more legacy here, right? Like we're not thinking about like more money this month with that type of structure. So you would transfer that money over through consulting fee, consulting revenue, and then you do your donations out of there up to the 30% that we talked about. You would do your salary out of there, the portion that's taxed for Social Security, things like that. And so then that allows you to pay a lower tax rate on the profit, but also to have those deductions be not taxable.
Do people ever use them? Do you have to have a certain amount of employees?
For a C-Corp?
Yeah.
No.
Do people just use them to like pay all their bills out of?
Sometimes that's not technically legal, right? If they're personal expenses.
Well, I was just thinking like, okay, what if all your income went into a C-Corp? It's, whatever, it's like 20%. Mm-hmm. And then, you can't take money out to like live on. So you basically have you could, but now you're double taxed.
Right.
Because you're going to pay 20%, then you're going to pay 40%. Mm-hmm. So it's like you kind of have to like pay most of your expenses through the biz, which most of my stuff is a write-off anyways.
Right. So you would move that over to there. You also would, if you're looking, again, to grow wealth, you have enough maybe from a W-2 or from other forms of income that are at lower tax rates than the C-Corp. You can leave that money in the C-Corp and keep growing the C-Corp. As far as growing assets in there, growing that, you can make donations out of there like we talked about. The only thing to keep in mind with that is putting real estate in that C-Corp. Then you miss out on that step up in cost basis when you pass away. Your kids are then going to be, because the C-Corp owned the property, right, or owned the asset instead of an individual. So you miss that step up in cost basis.
Yeah, because one of my friends was telling me if you have like a C-Corp for 5 years, you can then get an exit, and it's like your first 10 million on the exit is tax free. Have you heard of that?
I have not heard of that.
Yeah,
that's something worth looking into.
Yeah,
tax free.
Yeah, he said if you've had a C-Corp for 5 years, the first 10 million is tax free. And then he said the hack that a lot of people do is, you put your wife, your kids, and they each get 10 million tax free.
Oh, because they're all owners.
Yeah.
Okay.
And I was like, that's interesting.
Yeah, I'll need to learn more about that. I have not heard of that one, so thanks
you'll have to
thanks
let me
for
know.
that.
Yeah, because I was like, whoa, that's one I've never heard. He's like, yeah. So, if you're thinking about maybe one day selling, if you think it's going to be 5 years down the road, it could be very advantageous
to
do it now.
Absolutely.
I was like, oh, okay, that's good to know.
Yeah. I will file that one away.
Yeah.
Some reading on the plane ride back.
Yeah, if anyone in the comments knows, let me know. Let me know. Well, dude, it's been great talking to you, man. I love everything you're doing and all the people you're helping, especially like our students and the community and everything else. If somebody wants to get help, where do they go?
Yeah, so TaylorTaxStrategy.com is really easy. We're also on Facebook. And from there, they can book an appointment to talk with us about our services.
I love it.
Yeah.
Well, guys, go check him out. Greg is a great dude, not only just as a human being, but his heart to give. You know, he supports everything we do at Wealthy Kingdom and everything else. His heart to serve is top notch. And so you're definitely working out with a great person. So go check him out, and we'll see you on the next episode. Peace.
Thanks.